My Sunday was crappy. I literally spent all day doing an online driving school because I got a ticket last week.
For what? For speeding or for driving like a...
Worse, the thing that my wife is absolutely livid about, texting while driving.
They're very dangerous, Jay.
How do they prove that? Like, if you take that to court, how could they ever prove that you were texting while driving?
Literally, the cop was sitting in the lane next to me at a light while I was texting and was staring down at me.
Well, I guess that's a tough one to get out right there.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to episode 88 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and enjoy this episode, guys, because it was a great run, but this is the last time the four of us are together. We're taking a week off next week from, who is it? Who we losing? AJ? AJ, we losing you, buddy?
I'm out.
Yeah, what's going on, man? You're ditching us.
I'm ditching you guys. I got a grand opening down in Arizona, and then I will be up in the mountains with the family. So it's
What are you opening?
we have a big development down there, big storage facility.
Awesome, congrats. You still looking for investors?
So no, that one's done. It's ready to go. So
I was going to pitch for you.
Wait, Jay, do you have money to invest that you're holding out on me?
Jay, you know you can't get compensated. You know you can't get compensated for that, right?
Sorry. He puts all his money in my deals and then tells you he doesn't have any to put in yours.
AJ always has cool shit that he misses the podcast for. Like, he misses for like hunting trips in the wilderness with like satellite phones and things like that. So I always want to know why he's missing. Mauricio, it's always something dumb, like some party he just would rather go to. So it's interesting. So you drinking Diet Coke, I'm assuming, AJ?
Oh, yeah. I've got it. Red Solo Cup, Diet Coke, baby. Let's go.
I didn't know if you'd switch to some sort of like low calorie energy drink just because, you know, we're doing this weight loss challenge, but you're sticking to it. I respect that. Mauricio, what's up, buddy?
Dude, I'm so confused. As you can tell, I'm not at home and not in the regular studio. I'm in Arizona, which I believe I'm going to be missing AJ by like minutes because I leave on Wednesday. You get in on Wednesday. But, you know, Arizona doesn't change time zones. And so it's really confusing for someone on the West Coast, Pacific time, traveling to Arizona the day of the time change. I was all screwed up. And today I even showed up to this podcast an hour early. And so I'm already an hour in. I grabbed some Macallan's single malt scotch downstairs. It's almost done. Like I got nothing else.
Is that 10-year?
No, it's a 12-year. They didn't have anything more than 12. So I've got a 12-year Macallan's. It was actually a triple or a 6-ouncer or whatever, I guess that is. So, but yeah, it was like an hour ago. So now I'm like, now what am I going to do?
It's pre-tenure. Mauricio, you just got to learn to use your phone better because your phone, like, you just rely on it the day of the time change. It changes for you. Your calendar should just update and tell you what the time is adjusted and everything. So just, have your assistant instead of doing your emails, take care of that for you. Jay, what's up, man?
Nothing. I do have a little announcement. We had a little, not bet. We had a contest last week where you guys all knew your body fat percentage for our little weight loss bet, but I didn't know my body fat percentage. I asked people to take a guess in the YouTube comments. Turns out everybody thinks I am super obese. I think the lowest.
Well, okay, in their defense, Jay, you did like kind of anchor them. You baseline them that you were going to be above AJ. Because for the record, I would have won this bet because I said you were going to be between the two of them.
Yeah, and trust me, I expected to be much higher than both of them. So yeah, I probably did anchor everybody high, but it turns out that I was actually between Mauricio and AJ, came in at 31.5% body fat, according to the scan I did. And so just a quick shout out and congratulations to Kurt Muller. And I know Kurt. Kurt sends me emails every once in a while, checks in, sends me some good economic data here and there. So Kurt, you picked me at 36%. That was literally the lowest anybody picked was 36%.
By the way, but let me just stop you right here. Everybody who lost should throw in an appeal, should email the show, email Jay, complain, ask for a recount. Because unlike the rest of us who got a DEXA scan, which is the most accurate portrayal of body fat, you got some like, what was it, like the Sesame Street thing. I don't know what it's called. It's like it's some other test that basically looks at you and says you're 31% body fat. So the accuracy of that is very, very questionable.
I'm still going to try and do a DEXA scan. So I'll update if that changes. But for the time being, Kurt Moeller, reach out to me. What am I drinking? So my wife just very kindly delivered me a large glass of coffee. She forgot the Kahlua. So when you guys start talking, I'm going to run into the other room, grab some Kahlua, maybe grab some Bailey's Irish Cream, one or both, and do my Bailey's coffee.
Do a double Irish cream. It'll taste better.
Who says glass of coffee?
Did I say glass?
I've never heard a single person ever say that. Cup of coffee, mug of coffee, glass of coffee.
I didn't realize I said that. That was a slip of the tongue.
Weirdo over here just goes.
Okay, what are you drinking? What are you drinking, Kyle?
So I usually like to make jokes about it. I'm not going to make any joke about it. I'm drinking clear again. So I'm going to be drinking a lot of it during this weight loss challenge, sticking to my guns. I also I'm side-by-siding with an energy drink too. I got to keep it rolling here. I'm outside my normal. We're recording on Monday. I'm outside my normal routine. So gotta go. We got a good one for you too today. I don't know how long this is going to be because we got a couple topics that might be short, might be long. We're not sure. Someone's messing with my sheet right now and moving it around. But we're going to start. We talked in depth about how some recent policy changes have affected things like interest rates in the economy. But another thing we haven't discussed in a while is the strength of the U.S. dollar. And after the election, the U.S. dollar began steadily rising for a couple months there. But with this recent events, it's taken a significant hit. While most people would assume a strong dollar is always a good thing, as we discussed way back, what was it, 10 months ago, episode 44, I think it was. That's not always the case. So Mauricio, why don't you update us on the status of the dollar right now? What's going on with it? And then maybe we could talk about how investors should be worried or not worried about it.
Yeah, it's been almost a year now. I actually wanted to really focus on this. I was actually thinking about this dollar milkshake theory in conjunction with what's going on in the dollar. And actually, I'm actually going to focus more on what's going on with central banks around the world, because I thought that's kind of what triggered my thought on the dollar milkshake theory. But if you want to deep dive on the dollar milkshake theory on our end anyway, we did you mentioned, I think it's our second or third most popular video, which was about a year ago, episode 44. I don't want to leave anybody behind. So let me just recap really high level, like what the dollar milkshake theory is, because that's going to frame the conversation. And then if you want to do a deeper dive and see us argue about that, just go to episode 44. But dollar milkshake theory is a theory that has been put forward by a gentleman by the name of Brent Johnson, who's a huge fund manager. He manages a fund called Santiago Capital. And it's a framework that he uses to sort of, make decisions on how to invest people's money. He basically invests other people's money. He is under the belief that we are about to enter a sovereign debt crisis, which is going to affect the entire world, but ultimately is going to be benefiting the United States, and it's going to lead ultimately to a strong dollar. That's his theory. Now, when we say strong dollar, want to be very clear, we're talking about the dollar as it relates to other currencies. We're not talking about the strength of the dollar versus, your carton of eggs when you go to the store, right? Because obviously we know inflation's gone up. And so theoretically in the domestic economy, when you go to the store, your dollar is worth less than it was a year ago because it costs more to go buy gas and groceries and eggs and cars or whatever. So from that perspective, the dollar is actually losing purchasing power. But we're talking about the dollar as it relates to the euro, as it relates to the yen, as it relates to the yuan, as it relates to the Chilean peso, like all the other currencies. How does it relent a relative strength to those currencies? And what Brent's theory is, essentially, is that since 2009, when we had that huge, great financial crisis, the U.S. and all of the other central banks, by the way, just flooded the economy, the world's economy, with this liquidity, whether you want to call it, money printing or bailouts or whatever you want to call it. All of this liquidity poured into the world markets, and that's his milkshake. All of these dollars and yuans and yens and euros just flooded the market since 2009, and so that's the milkshake. And Brent's thesis, and this is like from 5 years ago, was like, hey, this 40-year bond run that's been unprecedented, interest rates down to zero, this has come to an end. Interest rates are going to start rising. And because of the US's unique position as the world's reserve currency, like it or not, but the world's reserve currency, military might, all of that stuff that you can agree or not agree, the bottom line is that the US is capable of maintaining higher interest rates relative to other countries when that is needed. And so what you saw actually, when we did this episode about a year ago, you were seeing how the U.S. was increasing interest rates. Obviously, we got all the way to about 5.25, and then the rest of the central banks were doing something similar. But the rest of the central banks were struggling more because they can't handle higher interest rates for long vis-a-vis the U.S. because the U.S. can always print money, right? If the shit hits the fan, which a lot of us believe it will, the U.S. can always just print money, right? It's got that ability to print money, export those dollars. There's a huge demand for the dollar. Unlike other countries like Venezuela, for example, is a great example. Venezuela starts printing Venezuelan pesos. Nobody else wants them, right? And so if you start printing a bunch of Venezuelan pesos, your inflation is going to go through the roof. Same thing with like the Japanese yen, which has been happening a lot lately too. Like they've been printing Japanese yen to buy their bonds to defend their currency against the dollar. And that takes an effect. The currency has lost a tremendous amount of value vis-a-vis the U.S. And so the milkshake or the straw of the milkshake is literally, he believes that all of that liquidity that's in the milkshake is going to be going towards the U.S. when other countries can't sustain that increased interest rate. Because think about it, if you're a Chinese investor or you're a worldwide investor and you're looking at where to put your money, if the U.S. interest rates are higher than interest rates in Germany or in Japan or somewhere else, money is going to be going to the United States because that's where money is treated better. And also people like the U.S. as a safe haven. So if you want to go buy real estate or treasuries or something in the U.S., and obviously you have to go buy dollars first. And so he's a big proponent of this idea that the dollar is going to strengthen, which is, by the way, not a good thing, according to Brent. I mean, this caused all kinds of problems to the rest of the world, which we discussed in episode 44. And, when we had that discussion, to your point, Kyle, I mean, I think the dollar was almost at an all-time high, not quite an all-time high, but one of the all-time highs when we had the conversation before. I think it was at 109. A year ago, it was about 105. It went down to 100, peaked all the way up to 109, and now it's kind of settled. It's been going down a lot in the last couple of weeks, and now it's down all the way down to 104. Which honestly, it's only down a little bit from a year ago. And so this is sort of a longer term thing. But the reason I got thinking of it, and I definitely want to talk about the dollar, but the reason I was thinking about it literally last week was I'm starting to see all these other central banks cut their interest rates, right? Just like we are. I mean, we're also cutting our interest rate, but the rate at which the other central banks are cutting their interest rates is much higher relative to the ones that we're doing. And so my thought here was like, well, I wonder what's going to happen with the dollar, because again, once you get that delta between the US interest rates and the interest rates around the world, if those start separating again, then you're going to have that sucking issue with the dollar milkshake where money is going to be flowing to the United States. I took a quick look. It was a great website I found. I'm not going to share it, but the US's interest rates, and when I say interest rates for the US, I'm talking about the Fed funds rate, not the 10-year, which we'll get to in a second. The Fed funds rate in the US peaked at 5.5 and is currently, I think, at 4.5, which is about an 18% drop from its peak. But if you start going through these other central banks, like the euro was at 4.5%. Now it's down to 2.65%. That's a 40% drop. The British pound is down 14. The Chilean peso, just because I'm from Chile, was 50%. The Japanese yen is the only one that's gone up, but it went up from like negative 10 basis points to now it's at like 0.5%. But Switzerland is down 71%. China's down 25%. So the other countries, other central banks are lowering their interest rates at a higher rate than we are holding our interest rates, which again is causing that delta. And so I was like, I wonder if this dollar milkshake is going to continue, because it's not a straight line, right? It went up to 108, it'll come down. But long term, is this going to continue? And that's when I looked at the dollar. And I was like, oh my goodness, it's been like literally in the last 2 or 3 weeks, it's actually the opposite has happened in the short term, where the dollar has gone down significantly. And so it's interesting discussion for us to have is, why is that happening? Why is the dollar suddenly not collapsing, but going down to about 104, especially in light of tariffs? Because we've talked about tariffs in the last couple of episodes. And generally speaking, when people start imposing tariffs, that generally is a strength for the local currency. So you would actually expect the dollar to strengthen or increase relative to other countries when you talk about tariffs, but the opposite is happening. And I think that's because there's a difference between putting tariffs on and having a full-on trade war where, we just found out today that Canada is imposing a 25% tariff on electricity. So in the short term, obviously, if you really want to focus myopically in the short term, you're seeing the dollar weaken. But I think if you're looking at the longer term, I'm very, very curious. I don't have an answer, but I'm very, very curious to see how the dollar is going to act in the next 3 to 6 to 9 to 12 months. as these central banks start to continue to cut their interest rates at a much more rapid rate than the US, especially if the US doesn't cut rates. If we keep our rates at 4.5, that's just going to put, I think, unless there's a recession and some, obviously some black swan, or if Jay's correct and April 4th comes around and everything collapses, then I would expect our interest rates to go down as well because of a recession. But I'll be interested to see if that does not happen, whether dollar will tend to strengthen back. Right now it's at 104, which is kind of if you look at the charts, it's kind of a nice little bottom and a resistance point. If it bounces off that, I'm curious to see if it'll get back up to sort of close to the all-time highs, which is sort of in that 115, 120. So I don't know what you guys have thought in terms of what's going on with the dollar and the interest rates.
I think a more interesting question here is, what do we want? Do we want a stronger dollar or do we want a weaker dollar? And the interesting thing is, I'm not going to go so far as to say I think Trump is purposely doing stuff to weaken the dollar. Maybe he is. But I think the fact that we're seeing a weaker dollar could be really good for the policies that he's trying to carry out. It could be really good in terms of trying to get the U.S. moving in the direction where he wants it to go. So number one, if we have a weaker dollar, typically that means that it's going to be more expensive for us to import stuff, but it's going to be cheaper for other countries to buy our stuff. And so a weaker dollar typically means that more exports, fewer imports. That kind of narrows the trade imbalance. But it also encourages American manufacturing. When you can export, when there's a lot of demand for stuff, that drives U.S. manufacturers to start building more stuff, creating more stuff, manufacturing more stuff. So number one, a weaker dollar could drive the trade imbalance in the direction that Trump wants it to go, basically closing that gap and encouraging onshoring of manufacturing. Number two, a weaker dollar means cheaper dollars, and cheaper dollars can pay off more debt. It's easier to pay off our debt with a weaker dollar than it is with a stronger dollar. So a weaker dollar can help in terms of the debt.
But isn't our debt denominated in dollars, so it wouldn't matter?
It's denominated in dollars, but if we create more debt, we're going to have foreign investors be able to buy more of our U.S. Treasury bonds. And so there's more demand. It pushes rates down. So, and then finally, foreign investment. So anytime the U.S. dollar is weak, as Mauricio pointed out, that means that other currencies are strong. And so foreign investors that are investing in their own currency can now move that currency into the U.S. And so that basically pushes other currencies into the U.S., which is good for the U.S. And so there are a lot of good reasons for, there are a lot of good reasons for wanting a weaker dollar. There's one really negative reason for it. I'm not worried about this, but the one negative, or the biggest negative, is simply if a dollar becomes too weak, you run the risk of losing the world's reserve currency. You run the risk of other countries wanting to trade in your dollar. You run the risk of other countries wanting to collect your dollars. I don't see that as a big risk right now. So I actually think seeing this downturn of the strength of the dollar is probably pretty good for the current administration and may actually help carry out some of the policies it wants to carry out.
Well, and you forwarded a great article. I mean, there's already talk about having some kind of a new, remember we had the Plaza Accord many, many years ago where they kind of restructured the entire world's economy or financial system, really. And there are already talks about maybe getting together and seeing if we can come up with a coordinated effort to weaken the dollar. Somehow you got to convince everyone that that's in the best interest of everyone around the world. Now, certainly for the debtors, who, remember, all of the debt, or the vast majority of the debt in the world, is U.S. denominated. So if you're a Chinese businessman and you have debt, you've got to pay that in dollars. And so if suddenly the dollar strengthens, you've got to basically exchange more of your currency for the dollars to pay your debt. So your debt becomes more expensive. So from that perspective, a weaker dollar is better for all the debt holders, corporate debt holders, or central bank debt holders. But on the other hand, it also weakens their assets. Like if they have treasuries on their balance sheets, which they all do, because that's one of the major reserves that they hold. Central banks hold treasuries, they hold some currency, they hold gold. But if the currency gets devalued, then that also impacts the value of their treasuries, their bonds, which is one of the reasons, by the way, it's one of the reasons why central banks hold gold. It's not some conspiracy theory that they don't want to hold other treasuries or whatever. It's just that they understand that that the purchasing power of the dollar is being eroded, net, maybe not as compared to other currencies, but net, the value of the dollar is dropping. It's just a question of whether it's dropping at a faster rate or not than other currencies. And so they hedge that by buying gold, because when that happens, gold goes up. And guess what's been happening over the last 6 months with gold? It's been very interesting to see that gold is almost at an all-time high. It's creeping on $3,000 an ounce, even as the dollar has increased, or even as the dollar's been going down now. You're still seeing gold, and the reason for that is just central banks are buying that like there's no tomorrow. The central bank buying gold is off the charts, and a main reason for that is because they feel like the purchasing power of the dollar, or the value of the dollar, independently, not in relation to other currencies, but as a whole, has been weakening.
Yeah, and I mean that reminds me of one other thing that one other benefit of a weak dollar. And again, this goes straight to something the administration's trying to accomplish, and AJ is going to talk about it later in the show. But specifically, a weak dollar often leads to interest rates going down, because when the dollar is weak, other countries don't necessarily want to invest. They don't have as many US dollars. They don't want as many US dollars. They don't want to take their dollars and invest in the US. They don't want to invest in our treasury bonds. And when we see our treasury bonds basically not getting a lot of foreign investment, what the Fed will typically do is they'll step in and they'll infuse a whole lot of capital into the bond market, and that'll push bonds down. Or bond yields down. And so a weaker dollar often leads to lower interest rates. Lower interest rates obviously are good for us as investors. It's good for the US as a country that creates a lot of debt. Lower rates are good for a lot of things. So, I mean, one of the negative things is weaker dollar can mean like it can have inflationary issues. But long story short, the fact that we're seeing the dollar weaken significantly, I don't think is a bad thing at all. And I think if we see it weaken even more, it might actually be really good.
When we say significantly, though, like what are we really talking about here? Because like we're as Mauricio said, yes, we're kind of back. We had a run up when Trump took office, because everyone's like, oh, he's all America first. It's gonna, it's gonna strengthen our position. The dollar started strengthening, but then like because of all this uncertainty, I feel like that's kind of what made it drop, which was surprising to me actually, because I thought volatility like would lead to a strengthening dollar. Typically, the U.S. dollar denomination is a flight to safety. So like all this volatility might be doing that, but it's also, with the whole tariffs thing, it's a bit of uncertainty with other markets as well, other major markets. He's talking about EU tariffs. He's talking about, he's obviously already done the Canada, the Mexico. So like, but we're still at like 104, or Jay put it up, 103.8.
So for those who aren't watching, I just threw up what's the US dollar index, which is the measure of the US dollar against a bunch of the most popular currencies on the planet. And right now we're at about 104. We were at 110 about a month ago, which was a major peak over the last, like historically. We have seen it go as high as back at like around 2001, 2002, where we were somewhere around 120. But for the most part, where we've been over the last month or two has been kind of the highest we've seen in decades.
And we've been bottoming out usually around that 100 mark. So it'll be interesting if it does continue to drop. And I think it's already dropped quite a bit. But I don't know. I would continue to think. I think a big reason why you're seeing a drop in the dollar is the same reason you're seeing a drop in interest rates, and why you're seeing a hike in gold is that just a fear of recession. I mean, when people are fearful of a potential recession, again, think of it as you're a China. I keep picking on the Chinese investor, but like when things are good, you want to buy U.S. assets, you want to buy U.S. real estate, you want to buy all this stuff. But if you feel like a recession's coming around the corner and things are going to go down, net, you're going to have less dollars coming in, less demand for dollars, because you're not going to want to buy those assets because you think they're going to be going down, at least when it comes to real estate.
But historically, like kind of the U.S. wags the dog a lot, right? Like if we go into recession, we kind of force a lot of other economies into a recession. And like if you take that a step further, especially with Trump in office, like I don't want to get too conspiracy theorist here, but we kind of are. We're going to get a little conspiracy theorist later, but I don't want, like if you take this farther down and we go into recession, and also it turns into kind of a global recession, which is common. if we do that, what are we going to do? We're going to print money, right? We're going to lower interest rates. We're going to print money. And what typically do we have to do for the rest of the world? The rest of the world needs US dollar liquidity. We just talked about they hold a lot of maturing debt that needs to get paid in US dollars. And where do they get it from? Well, we kind of like basically, correct me if I'm wrong, somebody really, this is kind of my amateur understanding of it, like extend credit lines to these other countries because we're doing it for ourselves and they're our allies and we're helping them out getting out of their own recessions by extending these US dollar credit lines because we can create US dollars. We're the only ones who can't.
But we have to. When at COVID, a lot of people don't realize a lot of the money we print is simply to shore up other countries. As in, if we didn't do that, they were gone. So we had to shore up other people's currencies in Europe. We have to shore up European currency in countries like Greece and others that we had to go and shore up because literally they couldn't. And if
let's take that a step further then. This is where the conspiracy theory gets into me. Like, if we've watched this administration, how they've worked so far, they're not giving anything away for free, right? Every single thing that they're giving out, they want something in return. And historically, we've just kind of just given that out. So if we get in a situation where other countries need this from us, I'm thinking this administration now is going to be like, you want us to do this for us? No problem. We're going to need this in return. And
but that might not be good enough, though, because and this is probably a topic for another thing. But there's this thing called, I don't know if you guys heard of the Triffin's dilemma, which is this idea that when you have a reserve currency, you do have to supply the rest of the world with dollars, and you've got the interest of the world also to consider, because you've got this awesome responsibility of being the world's reserve currency. We've already agreed when we agreed that we were going to be the reserve currency that we would supply enough dollars. There comes a time, though, where the interest of the U.S., the interest of the one who holds the reserve currency, is in conflict with the interest of the rest of the world, and that's the
or it doesn't even have to be in conflict. It like in your case, in Triffin's dilemma, yes, it is. It does become in conflict. But what I'm saying is, this doesn't even have to be in conflict. It just has to be like, hey, we need this from you, and he's going to be like, sure, if you give us X, Y, and Z. And they're going to be like, what do you mean? Like, you are the U.S., as you said, you're the reserve currency. Like, you need to do this in order for the global economy to work. And he's going to be like, well, tough. Like, you need it more than I need to give it to you. So, I'm going to need this in return. And that just kind of seems the way he's been working with foreign policy. The fact that he's coming at Canada, which is like his closest ally, like that just seems like something he would do.
It's not Trump that gets to decide shoring up banks and everything by the Fed.
Yeah, I mean, it's clear that he has a lot of control over everything in the executive branch, and he has a lot of pull in Congress. So at the end of the day, yeah, he may not be making the decision, but he has a lot of say.
If the Fed shores up in other central banks, no.
I'm sorry, your other central banks. Sorry.
Yeah, he has no control or say over the U.S. dollar and its standing, which pisses him off. But he can't literally tell a central bank, you're going to give me rights to whatever or whatnot, because it had already been done, and he doesn't have any authority there.
Yeah, it will be interesting seeing coming forward, because we haven't had that battle yet, right? Like, Trump's has all these other battles, and we talked in previous episodes about the kind of the looming conflict between the Fed and Trump, because we know Trump's going to want lower interest rates. He's a real estate investor. We all want lower interest rates. He's already said he wanted interest rates. Last time he butted heads with Powell because he wanted lower interest rates, and Powell was saying no, and then eventually caved. We know it's coming. So it'll be interesting, kind of that dynamic between there. But I just thought I'd throw that conspiracy theory out there that it's, it might not be as rosy and as easy to get out of a global recession as it was before.
We've been talking about doing a conspiracy theory episode for like 2 years now. We need to put one on the calendar.
Yeah, we do.
Okay, 2 weeks from now.
All right,
maybe our 100th episode could be a conspiracy theory episode.
That's not a bad idea.
That would be a great one. So I guess the question is this something that's significant enough for us to start worrying about it as investors? I mean, we discussed briefly there about how, okay, if a weakening U.S. dollar, how that affects investments in our deals. Volatility in itself actually usually helps, because that brings in more dollars to here, which actually, like, if you use the example of someone in China, if there's volatility in their currency or volatility just in the world in general, they're going to want more US denominated assets, which they're going to come and they're going to invest in our syndications more often. But with what we're seeing right now, do we see it affecting real estate in general, or is it just kind of, okay, we're hoping to get more money from foreign investors?
I think the interest rate plays a much higher role in that. I mean, you just saw, yeah, I just saw the mortgage. I think the refinance on mortgage rates have come down because the 10 years come down over the last couple of weeks, and so now you're at relative records of refinances of the mortgage rates. I don't know, the highest in a couple of years or whatever. So I think the interest rate is something I would be paying much more attention to. And again, we've talked about this before, but I believe that the interest rate is going down. Well, I know the interest rate is going down because there's a higher demand for the treasuries. That's a fact. Now the question is, why is there a higher demand for treasuries? And the argument that I will propose is that because there are people that are more fearful and they're concerned about a recession, and so they usually flight to safety, and so they're flocking to treasuries, which is driving down yields. And so the question is, do you want lower interest rates? Here's a good question: do you prefer lower interest rates and a recession, or higher interest rates and no recession?
I mean, that's a tough one. Like, what kind of recession are we talking about? Are we talking about a baby recession? Are we talking about a global
You got to factor
recession?
that into your risk. That's a risk. That's a risk adjusted analysis.
And here's the thing. I think a lot of people were spoiled during 2020. But if you go back and you read my book on real estate investing throughout the economic cycle, what you're going to learn is that typically low interest rates are tied to recessions. What drives interest rates up is when you get into this growth economy and things get so overheated that we have inflation. And so the Fed raises rates and raises rates and raises rates to the point where we get into a recession because rates are so high and nobody can borrow money anymore. And how does the Fed get us out of that recession? They drop interest rates. And so we saw that in 2020 because we saw this massive recession, but it only lasted a couple months. And so when we think back to 2020, we think about like we had 0% interest rates, but we forget about the fact that the reason we did that was because for a couple months we were in the biggest recession in the history of this country because of COVID. And so there's the correlation, but we forget that correlation because all we remember is 0% interest rates and booming economy in 2020, late 2020, 2021, real estate going through the roof. But the reality is you don't normally get low interest rates without a recession.
Well, it's also because the Fed's always slow to act both ways, right? Like they're too late to lower them and too late to raise them. And so what we remember is that time when they should have been raising, but they weren't, right? So then they waited a little bit too long, so things got a little frothy. We had low interest rates and we also had a good economy, and they should have been trying to cool it down, but they didn't. So then things just took off, and by the time that they recognized what was going on, then it was too late. So that's kind of, I guess that's why our memory is a little short.
And that, by the way, that just drives me crazy too, because the interest rates going up and down being decided by the Fed and whether we're in recession. I mean, really, interest rates, as we know, is the price of money. It should be dictated by the supply and demand of money, meaning when there's a lot of savings and there's a glut of savings, then interest rates should come down because there's more money than there's demand for it. And when people don't save enough money, interest rates should go up because there's more demand for the money that's not out there. But instead of that, we have this artificial Fed raising.
I'm sure we will have a Kill the Fed segment at some point.
Let's do a Kill the Fed. That's another episode that we could do.
Well, actually, I am going to adjust this a little bit. I was going to go to the next topic for Jay for the government shutdown. But since we're talking so much about interest rates here, we did have a bit of a discussion about Trump's priorities, because it was obvious last time Trump kind of used as a barometer and like how well he was doing the stock market. He talked a lot about stock markets doing so well, and that was a barometer for how well he was doing. And this time it doesn't, he obviously cares about it, but he doesn't necessarily seem to care about it as much. And people are hypothesizing that he cares more about like the 10-year rates, like the interest rates and what those are doing and getting those rates down. And if you take that a step further, you're like, well, why would he want so badly interest rates down? The obvious question would just immediately be, okay, the answer to that would be, he's a real estate guy. But there's another explanation why he would want rates lower in a hurry. And that's where AJ came in, and he was like, well, take a look at our looming debt that's coming due and what we're going to have to refinance in a little bit. So AJ, why don't you touch on that a little?
Yeah, we have the largest debt ever in the history of the United States. 30% come due this year. and it's also correlated with high interest rates. So the government is looking now to the debt has to turn over. It's 30% of our debt, and that's 1 year. It's over the next 5 years, and we have these high interest rates. So the government's now in a really bad spot because the Fed issues it, but the government buys or has to pay it, and we can't pay for anything. In fact, not only can we not pay for anything, we're trillions and trillions of dollars short. And this adds hundreds and billions of dollars to our payment. It's so big if the interest rates, depending, are high enough to where we've seen them over the last 12 months. You're talking about the expense could be larger than every other expense that we even have, the government has. You're talking about not only larger than defense, but almost double. So just interest rates, just the interest on it, which is literally the potential of a sliding, cascading downfall that is really bad. Because if your now debt servicing is bigger than taking care of your citizens, paying for military, it's bigger than everything. And you now have to take debt to pay debt. This is a death spiral. And that death spiral is exasperated because people don't believe in you. So guess what happens? Your interest rates go up. And as interest rates are going up over the next 5-6 years, we're refinancing or having all of this debt come due. And you're doing it at higher and higher interest rates, which exasperates the problem. And on top of that, what happens is people don't believe in it. The interest rates of the government that the government has to pay affects what we have to pay. So in coordination, then, interest rates are rising for Main Street, and Main Street is the economy. The economy starts shrinking, so the amount of money that the government can pull from the economy shrinks. So it can be a very dangerous situation, very dangerous. And when you look at that, the question is almost a moral question. Is it better to tank the economy, to have interest rates drop, and we save hundreds of billions of dollars of taxpayers' money? Or do you save the economy, but then because the economy is so hot, we have high interest rates, and now taxpayers have to, for the entire length of the loan, pay hundreds of billions of dollars a year, $300 billion plus dollars a year, and our total interest rates over $1 trillion. There's estimates of $1.3, $1.4 trillion just in interest payments. And our economy doesn't even make $5 trillion. So it's like 4.8 or 4.9. So
Hey AJ,
Yeah.
can I jump in just with a
Yeah,
little bit
go
of
for it.
math real quick? Just because I think a lot of people don't understand this. Even it's simple, and I think it's so simple that people don't realize it. So for everybody listening, if you want to know how much interest we pay on our debt, we've got $37 trillion in debt. The average interest payment, which is about the average of all of the bonds that we create right now, is 3.3% or so. So all the bonds that get issued that get sold are on average 3.3%. So if you want to know how much we pay in debt every year, it's that 37 trillion times 3.3%, which is about $1.2 trillion this year that we'll pay in interest. And so if the average bond rate this year is above 3.3%, we're going to pay more interest on that outstanding debt. If it's lower
and
than
we're
3.3,
refinancing debt that was at 2.
right? Or right,
2.5.
exactly.
So
Exactly.
our average is 3 because interest rate 3.3 because it's been coming up. But the debt that we're refinancing is at ultra low interest rates. We're talking Obama era, like after Great Recession interest rates. So
Yep. And short-term stuff that was originated in 2020. That's like 5-year debt from 2020 that's coming due was at zero.
Every single I don't think there's. I mean, even a 30-year. Correct me if I'm wrong. Like we would be refinancing into a higher rate.
Yes, it's just that the problem is so massive, and it's one of the reasons this debt. You have long-term and short-term debt cycles. The economy long-term debt cycles can be eradicated. It's not good. Unemployment spikes, people go hungry, it's people lose their homes, debts, everything else like that. But the private sector has means to deal with it. It literally can eradicate debt and wealth, and people can lose what they have, right? And it goes away. So a lot of times we correlate that as in, well, they can go bankrupt or we can wipe away debt. But what happened in 2008, that was the end of a debt cycle that had lasted since basically the Great Depression. And that debt didn't get eradicated like every other financial crisis we've ever had. It got transferred. It was transferred from the private sector to the public sector. And the public sector can't go bankrupt without it hurting everything else. So in the economy, you have entire industries that can go away. Just literally go belly up. Investors lose their money, people get unemployed, but the economy doesn't end. The government doesn't act like that. You can't be like, oh, well, we're going to slice off this and not have it affect that at all. It is it's kind of an all or nothing type thing. And when you're out of whack, the United States government just can't go get more money, as in it can't make the economy yield it more money. The economy has to do its own thing. It can only pull so much from that, right? Until it starts actually making the problem worse or exacerbating it. So when that happens, when the government's faced with that, when all this refinance, which is essentially what blew up the economy in 2008, bad mortgages, interest rates went up, you had defaults. Well, that on the government side is of epic proportions bad, because what it does is it actually, the government that saved us in 2008 isn't there to save the government. It tanks the economy. So it's direct correlation, and it creates a downward spiral. And it's scary. It's a lot of people thought, oh, well, it's okay. We have debt at 2.5%. And you had a lot of people for the last politicians that just said, we can essentially take as much debt on as we want because we're the reserve currency. The problem is, though, who buys it and what rate do you pay it at? So it's these two things that are colliding at the same time. If we paid 2%, it wouldn't be nearly the issue. But they're not refinancing it too. They're refinancing it over double that. So now all of a sudden, if we wouldn't be in that position, it may be just fine, right? Because we're already paying it, everything else. But they're not. So then it comes, how do you solve that problem? If you tank the economy, if we go into a recession, interest rates will go down. But is that better? That really is a question. Is it literally better for us to go into it to avoid this problem?
So there's two things going on here. One is the overall picture, which I agree with you. It's a death spiral already. I mean, I've been following this for 15, 20 years. I mean, back when interest rates were at zero, I was tracking this when our debt for the entire, first of all, our debt was like 20 trillion, but it was like at 2% or 2.25%. In fact, I think I mentioned that a couple of months ago and you guys corrected. No, now it's up to 3.25%. So it's already increasing. We are at about $1 trillion, give it some say a little bit less, some say a little bit more, but let's just call it $1 trillion for round numbers. We're at about 4.9 trillion for receipts, revenues. Let's call it 5 trillion. So we're at a 20% debt to revenue. Like everybody talks about debt to GDP, which I think is a bunch of baloney. Like you want to look at what is the revenue that I'm receiving as a country, and that's 5 trillion round numbers. And I pay $1 trillion in interest only. That means when you send a check to the government to pay your taxes, and you send a $10,000 check to the government, 2,000 of that is just to pay interest on the credit card that we have. So let's keep that in mind. So, and that's just getting worse and worse and worse because we're anticipated, I think, for another 1.8 trillion in deficits this year. I mean, the number and we're in peacetime. We're not even in a recession. We're not even going through tough times. So just imagine if things were going wrong. The only pushback I will give, AJ, and just correct me if I'm wrong, because you did a deep dive into that. I threw some quick numbers at this, but 30% in terms of like crashing the economy and how big of an issue this is. I mean, I know it's another notch on the belt and it's another thing in the wrong direction, but if it's 30% that needs to be refinanced, that's about, give or take, $10 trillion that need to be refinanced. For every percentage point more that we have to pay, we're talking about $100 billion, which, don't get me wrong, is not nothing. But when your interest is already at $1 trillion, $1.1 trillion, another 0.1 or 0.2 doesn't seem like it's going to move the needle, but it's not some catastrophic thing that would warrant you even considering making, the crashing the economy, making it worse for everyone. Unless my numbers are off, we're refinancing from, let's say, 2.5, somewhere around there, to let's say 4.25. That's maybe a 1.5 more, which is not insignificant. But on $10 trillion, that's 100 to 200 billion more, which back in the day was a lot of money, but now it's like, a couple hundred billion here, a couple hundred billion there. At some point, it becomes real money.
The problem, I think, is that interest rates have began to reflect the financial position of the United States. So the United States and the overall position that we are in, you actually have a problem with long-term rates. Long-term rates have not been nearly as easy because we're so out of whack. And you have to remember that, let me show you this, what has happened since 2020 is unreal. This happened fast, everybody. This is not something that we say, oh yeah, well, we should have seen it coming. We should, no, this happened really, really fast. And it happened fast for a whole bunch of reasons. But now we have inflation tied to the fact that the government has been just out of control. Interest rates are having almost impossible time to come down. And when you look at why and what's been going on, there's a few reasons. So essentially, if the government, when the government takes money or puts money into the economy, that doesn't always increase the money supply. So if the government pulls taxes from the economy and then uses that to put it back in the economy, that doesn't increase the money supply, right? So you can actually have where the government is spending more and more and more, but it's not increasing the money supply. That's not what happened, though, starting in really 2020. So when you look at the inflation rate and the federal funds rate, interest rates have to come up to get inflation down. What happened, though, was at this time, especially in 2020, the United States government started to print trillions of dollars into the economy of debt. So it magically made money and started pumping new money into the economy. And it did this at the same time interest rates went up and offset the whole of money that interest rates created. So interest rates going up stops money flow. But the Fed offset that, the government offset what the Fed was doing by printing money. And that created a situation where the Fed was like, we can't drop interest rates. So even though inflation came down, we can't drop interest rates. And our long-term debt, people started to not want it as much. So the chart here that you can see is that effect that money spending from the government had. Now, that all comes at this time. So it's like in a matter of 2020 to here, we backed ourselves into a corner. We literally just painted a corner, right? Because the long-term interest rates at the same time, the horrible financial position that the government's in, people are not wanting it as much. They're just not wanting to take it on. So interest rates have remained high. And that is the problem. So whether or not it completely destroys everything or not, the key is this. That notch or that ticket can make it harder for us to get interest rates down. And the threat is what everybody wonders is when are we hitting that domino? We don't actually know. And what has happened in the last 4 years and come to this point, that was so by surprise, right? COVID was, everything was. And this is Trump and Biden. I mean, they just went bonkers. And all of a sudden now we're in a place where and two, at the same time, they said, no, inflation's not going to happen. We're not going to have that. And so we have a 3-year period of time where the whole entire landscape changed. And at some point, when do people say we're going to stop buying those bonds? The only thing right now that could help is you have a recession, then there's no good way to allocate that much capital. So instead, they drive it to bonds and that interest rate comes down because the Fed is kind of tapped and they've said that repeatedly.
Here's my concern. And I think the most important thing that will be said on this episode, no offense to Mauricio or to Kyle or myself, but the most important thing that's been said on this episode was earlier when you made the point that in 2008, debt was transferred. And I want to reiterate that. So let's think about the good thing about recessions. And you said this, I'm just reiterating it because it was so important. I'm not trying to talk over you. It's so important. The good part about a recession is debt goes away. People go into foreclosure and they lose their mortgage debt. People get their cars taken back and they lose their car debt. They go into bankruptcy and they lose their credit card debt. Businesses go out of business and lose all of their debt. And it's bad for people. It's bad for businesses. It's bad for the nation. But it's good from a debt standpoint because all this debt goes away and we get to start over. And what happened in 2008, I'm not going to say for the first time, but for the first major time, was instead of letting this debt go away, the administration, the Obama administration said, we're not going to let that debt go away. This problem is so bad, or whatever the rationale was, we're going to bail them out. And so, as an example, banks were failing. And so we had this thing called TARP, and TARP allocated, I think, $700 billion. So $750 billion.
That was a lot of money back then. I remember too. $700 billion was like, oh my gosh.
Our total debt after 2008 was $10 trillion. What's coming due today? The total government debt.
So in 2008, 2009, banks were about to lose $700 billion in debt if we just would have let them go out of business. And that would have cleared out that debt and kind of let us start over. But the government said, nope, we're going to bail you out. And so that debt didn't go away. Just as AJ said, it was transferred. It went from being the bank's debt to now being the government's debt because they had to print money. The Fed had to print money and sell assets to raise this money. And so we've transferred that debt from the private sector to the public sector. And literally, it's the most important thing that'll be said on this episode. Here's my concern. Let's say we see that recession in 2 months or next year or the year after. Is the government going to do the same thing? Because Obama did it. Trump did it at the beginning of COVID. Biden did it for the rest of COVID and several years. If they do it again, if they just transfer that debt again, say it again. And Bush did it too, exactly, in 2001. Absolutely. And probably towards the beginning of at the end of 2007. And so all we're doing is we're pushing it further down the road. We're not letting that debt clear. We're transferring the debt from the private sector to the government sector. And even if we do get interest rates down and we save a little money on our interest, we're increasing the debt by taking on all that private sector debt, which just compounds the problem. So even if we have an extra point or two shaved off the interest rate, we might have another $5 trillion added to the debt. Did we really help anything? And so we have to do two things. We need to get our interest rate down, but we also have to stop transferring that debt from the private sector to the public sector. And that's going to mean a really, I know I'm going to say it now, Trump's going to get beaten to hell over saying to the Fed, don't do all these bailouts. And people are going to freak out. But let me tell you something, it is the right thing to do. Somebody needs to put their foot down and say, bad stuff has to happen so that in 5 years, 10 years, 20 years, this country doesn't go away.
Well, otherwise it's just a Ponzi scheme, right? Like what's the definition of a Ponzi scheme? You're taking new investors' money to pay old investors. And that's literally in this system, that's what we're doing. Our interest rate payments are getting to the point where we're going to have to take in new debt. We're going to have to create new debt. So we're getting new investors to pay back the investors that we already owe. And that's the definition of a Ponzi scheme.
Yes.
That's literally what we're running right now.
And the problem is you can't now, if the problem is so big, the economy can't take care of it. This is the thing that I think is so key. It's so big, the economy cannot take care of it anymore. So you're running into a problem here as interest rates rise, everything else, where we have $35 trillion in debt. Over the next 5 years, we have $15 trillion of it coming due, high interest rates, and you can't tax enough anymore. Like that passed, that's gone now. Like you would have to sell off the economy. That means that's what I meant by you're painting yourself into a hole. And so my worry is that we get in a spot where that rosy outlook of the United States, the dollar, everything else, is those long-term interest rates that we have. People just don't want bonds. And we've seen this.
Yeah,
we've seen this happen.
AJ, my pushback there, and I'm going to tongue in cheek say this is the second most important thing that is going to be said on this podcast, but that is that the rest of the world is doing the same thing. We're not the only ones who are bailing out and transferring and doing all that. So you said something, AJ, well, who's going to buy our bonds? And I'm like, well, where else? What else are you going to buy, AJ? You're going to go to Germany and buy some German bonds? You're going to go to China and buy some Chinese bonds? Like what? We're the cleanest. We're the cleanest dirty shirt or whatever. So
And we talked about this before too. It's literally like hedge funds and certain like all these big conglomerates almost have a requirement to have fixed rate assets, which are the as you said, the cleanest shirt fixed asset.
65% now is U.S. citizens to buy it.
So if we're in a terrible shape, that I get it, we are. But if the country next to us is in even worse shape, then relative to that country, we're better off. And so capital still will flow. People would rather buy a building here in the United States than go buy a building in China,
and I think you're exactly right. And I think that's the saving grace. And two, I think that you get into the conspiracy stuff. Is that literally what like Trump is doing? Because the question is, other countries have to be in a bad shape too. Well, if we're going to go down, you take other people down, it exasperates that. And now I don't think Trump thinks forward like that. I don't think that do. But it's interesting that we actually might get lucky by him creating a recession here, dropping interest rates and doing it through tariffs, because he's tanking the currency of like Canada and Mexico, and GDP outlooks are tanking. And then you have that thing with Mauricio where everybody's like, you're not buying the euro. You're not buying, the peso. You're definitely not buying the yen.
Guess what you're buying? Guess what you're buying? If you're into that currency, you're buying gold. Gold is, and one of the reasons why gold is.
There's not even enough for it. So it's not even if you wanted to. There's not enough. And so like that has kind of been our saving grace. And that's why I say I don't know the total impact, and what it may not be that first domino, but it could be. We could look back on it and say 2025 was the year that it all changed. And I think that to me is it's nerve wracking. And the fact that we're having this discussion on this podcast, and people just aren't talking about it. And and I'm like, politicians you would think would be like, guys, whatever you do with the government, cut spending, anything else, we're going to have $400 trillion increase. Or $1 billion, $400 billion increase. So we're talking about cutting $100 billion from government spending when we're going to increase in interest payments $400 billion.
So I guess my question is, as investors, like what's our baseline of what we believe is going to happen? Like, I think it's naive for us to say that anyone's got their fingers on this pulse in the government. Like, if you look at the proposed budget, I know there's been a lot of proposed budgets on it, but the one that I actually saw like printed out, like they don't have the interest rate payments going up by this amount. Like they basically kind of have it as the same as what it is now. So like this new budget that they're coming up, they could talk about, we're going to increase that, decrease that, all that stuff. Like they're not factoring in for this massive increase in interest rates. So are we like, if we're looking at, okay, how are we going to be spending our money? How are we going to be investing? How are we going to be treating our assets going forward? What's the baseline that we should be using of what's going to happen?
I think the baseline is, and we've talked about this before, that we use is the idea that interest rates are just going to come down. I think there's multiple things going on. We have inflation, you have tariffs, which are inflationary, and we have some other things. A recession would help that, right, in the short term. But I think the long-term outlook, investing and underwriting for cap rates to drop in association with lower interest rates, where your money's coming from, new development, new supply, is very contingent on these interest rates and a condition that allows for it. And so we are really looking at, and we underwrite out in our things, is interest rates aren't going to substantially come down. And if they do, it'd be in the short term, right? Because of something that would be a corresponding factor. Like in the next 2 months, the recession happens, and then we can get interest rates to come down. But I think long-term investors, and I think it's great. We just had this, we made a post and it was something like 20,000 people, and all the comments were like, this is why I'm waiting for interest rates to come down. And it's amazing how many investors out there are holding off. And they're like, once interest rates get down to, again, to 3.5, maybe 4%, then I'm going to jump back in the game. We're not looking at it under the assumption that's going to happen. So when we buy, we can't be buying and being bailed out in the future by lower cap rates or thinking that interest rates are going to come down. I think
It's kind of like those investors that are saying, "Oh, I'm going to get back in the market once I see a 20% correction," and then they wait 3 years.
And they wait, and then they're 50% above. Exactly. And I think you got to underwrite more carefully now. The idea that the market basically is going to bail you out, I would not be doing that. And a lot of investors, that's the assumption. I'm just going to buy. Cap rates are going to go down. Market prices are going to go up. And it's this idea, because we're so used to it, that cheap money, lower interest rates just push massively asset prices up. That's a worrying strategy. I think it needs to be value-based. You need to be looking at cash flow. You need to be saying, how's the long run on this play out? What are we getting? What's the yield from this? And expecting a bailout at the end, which is traditional, that worries me right now.
So this might be a larger discussion, and if we get to the end of this and decide we need to discuss it further, we could just cut this segment. But the one thing that when you talk about like planning for interest rates coming down, planning for cap rates coming down, planning for all those things, the one thing that I'm more wary about right now is one of the big reasons that people were doing floating debt. And everyone points at, okay, you could get these bridge loans and get higher interest or higher LTVs, and that's why everyone took them. There's another reason that floating debt, and we have floating debt on one of our properties now. It's a Freddie floating debt, so it's not one of those high LTV loans. So we're still okay. But one of the reasons we got one of the floating rate debt is because things were changing so rapidly that fixed rate debt was kind of pigeonholing us, in the sense that we would buy a good asset, we would do really well, and those cap rates did come down, even though we didn't say that wasn't our plan, but they did come down. It still happened, but it happened at year 2. And the problem is that we got a 10-year loan. And if you have fixed rate debt on a 10-year loan at these interest rates right now, and we have a significant lowering of cap rates, that's probably, as you said, in conjunction with some lowering of interest rates. And so if we go to sell and get out of these fixed rate debt loans, the prepayment penalties are astronomical. And so you'd have these things where the value of your property went up, 30, 40%. But the problem is that if you try to exit it, you're paying millions and millions, sometimes like $6 million in prepayment penalties. And
I locked
yield
myself
maintenance
out of $50 million, Kyle. I literally locked myself out of $50 million of equity because in 2009, I said there's no possible way interest rates could go below 5%. And so we did that longer fix, right? Now we don't, everything has to have no prepayment penalties, maybe a prepayment penalty in year 1 or 2. But because of what you're talking about, I screwed the pooch. And that was devastating.
Well, but so I guess my question is, what's the ideal loan right now? What are you looking at as far as your baseline loan? Because I'm kind of what I flip-flop back and forth, and kind of what I'm on right now is a shorter term fixed loan where I'm looking okay, worst case scenario, if I'm getting a 5-year, because you can get a 5-year, a 5-year, in our case, 5-year Fannie and Freddie. If you can get a 5-year one, then at least if this happens, if I buy this asset and it happens in 2 years, then yes, it's going to hurt if I want to exit right at that moment, but the prepayment penalty is not going to be this astronomical amount that it would if I got the 10-year. And I guess I feel relatively safe that sometime from between now and the next 5 years, there should be a good exit window at some point to once we get to year 3, we say, okay, the next time we get an exit window, we got to get out.
Yeah, I want no prepayment penalties. I don't know how it works in multifamily or whatnot, but we're putting down more. I mean, I don't know about you guys, but right now banks are requiring more down. I would rather put more down today and have no prepayment penalties than put less down. And so when
we can't really have it both ways. So it's, if you're going fixed debt, you're going most likely a Fannie or Freddie or a CMBS, or it's, it's very, those are the kind of gold standard loans. And if you're getting those loans and it's fixed, then you're going to have prepayment penalties, whether yield maintenance or step down basis or something like that. You're going to, it's just, it's the nature of the beast, right? If you're reselling these package loans, by definition, these mortgage backed securities, if you exit early, then those investors need to be made whole, right? Like they were bought as a package. It needs to be made whole, and that has to come from me, the person who took out the loan. And so I guess it's just one of those, like, trying to, like, how opportunistic are we going to be with our loans? And that if I got a floater, then I could exit early. But then, you kind of have that uncertainty. We got burned on our one floater where we're, every year we're having to deal with, okay, we've got to set aside reserves for these, for these banks every year just because it's a floater.
Can you avoid it by personally guaranteeing? Because we can't. So what we're doing is we're putting a little more down, and then I'm personally guaranteeing it until refi. I'm not suggesting that to people.
I don't know what the size of your loans are, but the properties we're looking at are like 20 plus million, and the personal guarantees are, significant. So like, it's like, and personal guarantee, you can't get personal guarantees on Fannie Freddie.
Okay. That's a very different loan then.
Right. So anyway, that's a discussion for another day. Jay's giving me the wrap up signal, and Jay's in charge here.
I'm literally in this business. I deal with this every day, and you just bored the hell out of me.
You know what? But Jay, if there's one or two people who are paying attention, who are underwriting these deals, I feel like it's really important. Like, deciding, like, one of the most important decisions somebody made, and they didn't know it was the most important decision, was the loan that they picked when they bought a property 2 or 3 years ago.
How dare you talk about real estate on Drunk Real Estate? Yeah,
exactly. Like, if 3 years ago, there will be someone, if they had just picked this loan instead of this loan and bought that property, their property would be fine right now, but instead they're in foreclosure. Instead they're doing capital calls. Instead they're doing one of those things. So these discussions are important, but Jay's all bored out of his mind because we're not talking about Trump or, something sexy, tariffs or something like that. And his one's already gone. So we just wait. We got to get to Jay's government shutdown.
We don't have to talk about it at all. We're already like 18 hours into this thing.
We could skip it. You guys want to skip Jay's segment? That would be a nice breath of fresh air to have Jay not have to do a segment. AJ didn't have to do a segment for a couple of weeks there. We could just skip Jay's this time. Anyone want to vote?
It's not going to next week. It's not going to be nearly as interesting, this topic. So it's now or never.
All right. Well, that's fair. We did touch on it a little bit about how this net interest isn't really factored in the budget. They keep discussing other things, and we have a Republican House, Republican Senate, Republican presidential office, and we still can't get this shit passed. This shit should have been passed last October as far as a 2025 budget. It's not. And I looked this up because I wanted to have like a quote of like procrastination is the. So I typed it in Google, and you know what the top three were? Top three are procrastination is the thief of time. Procrastination is the enemy of progress. And the last one was my favorite. Procrastination is the arrogant assumption that God owes you another chance tomorrow when he gave you a chance to do today.
Oh, that's an awesome quote. I want to get that. That's a great quote.
And so I feel like someone has to tell the government this, because that's their MO is procrastination. And now the government is only funded through the end of this week. We're down to that point. And they kind of just like, the House proposes this and the Senate proposes this, and then they take a couple days, and all of a sudden we're down to the end of this week. So I guess, Jay, the question is, at the end of this week, we could see a partial, at least, government shutdown. Or is this going to be just like, I feel like we've discussed this multiple times, where they just keep pushing it off until Janet Yellen has to do extraordinary measures, and then they finally get it done at the last moment.
No, so there's no extraordinary measures here. You're thinking of debt ceiling. This is the budget. So let me, since there's a little confusion, let me start with a little bit of how this typically works. So a lot of people are surprised to know that the U.S. government's fiscal year, their year starts on October 1st. So 2025 for the U.S. government started last October 1st, not January 1st, like most of us and most businesses, which means that if Congress were any good at their job, we would have had a budget before last October 1st. In practice, this never happens anymore. So a budget bill, sometimes called an appropriations bill, or normally called an appropriations bill, basically has 12 parts to it. And so like you pass the budget for the energy department, you pass a budget for defense, you pass a budget for Homeland Security, and all 12 of the big agencies or groups of agencies. So any budget bill for a year is actually 12 separate parts. The last time we actually passed this 12-part budget bill before October 1st of the year before, Bill Clinton was president. So we never passed this bill anymore in
Let's
time.
bring back Bill. Everything was great under Bill Clinton. All we had to worry about was what was going on under the desk, not out in the Congress hall.
And so basically we never passed this bill on time anymore. In fact, we haven't passed even 5 out of the 12. We haven't passed more than 5 out of the 12 bills before October 1st since the last time Bill Clinton passed the entire thing. The last time we even had one of the 12 passed before October 1st was back in 2019. So basically, this never happens anymore. The other thing to mention is that this appropriations bill, the spending bill, only covers discretionary spending. It doesn't cover things like Social Security, Medicare, all the interest payments on the debt, all these other mandatory things. We have separate laws for that. This is just the law that covers that 1.8 trillion or so of discretionary spending. Okay, before we get that law, before we get that appropriations bill, first thing the House and the Senate have to do is they have to pass this thing called a budget resolution. And this just lays out the general spending guidelines for the year. How much are we going to put towards this sort of stuff? How much are we going to put towards defense? How much are we going to put towards tax cuts, et cetera, et cetera? Both the House and the Senate have to sign it. Target date for that is April 15th. So I'm not saying April 15th like this coming April 15th. This should have been done by last April 15th. So for the 2025 budget, this should have been done by the last Congress, last administration, back last April. Obviously wasn't done. The House and the Senate passed this budget resolution, this general high-level guidelines for the budget just last week. And the House passed one and the Senate passed their own. So I'm
guessing last year was a little bit tumultuous too, because the Republicans, obviously, they don't want the Democrats putting in their own budget and doing when they believe they might be, taking everything back.
100%. And it's both sides. I mean, both sides are playing politics against each other. But at the end of the day, we don't even have a budget resolution. We don't have these high-level guidelines because the House passed one last week, the Senate passed one last week, and they haven't yet agreed on one that they can both sign. So we don't yet have this budget resolution. But once we have this budget resolution, House signs it, the Senate signs it, President signs it, and then we can have a budget bill. Obviously, all this didn't happen before October 1st of last year. So what do you do when October 1st comes around? Well, this is the government budget. And if you look at the Constitution, Article 2 of the Constitution says that money can't be spent from the government without a law. There has to be a law in place to spend money, and only Congress can pass laws. So that means we need this budget bill or all money stops flowing out of the government. And it's not like the debt ceiling where we can do these emergency actions or whatever they're called, where we can just kind of play around and money's fungible. Literally, we have to stop spending money because constitutionally, we can't spend money if there's no bill. What Congress can do, though, is they can pass a separate bill that's not this full budget called a continuing resolution, or CR. And the continuing resolution basically says, we're just going to stick with the budget from the last year for the most part, maybe a few changes here and there, but we don't have a bill yet, so we're just going to pass this other bill, this continuing resolution that basically just lets us continue the budget from the previous year, basically the same spending patterns.
Which kind of looks like that's what's going to happen for what I see.
Yes. So when we didn't have a budget for October 1st, back in the end of September, Congress passed the first CR, the first continuing resolution, said, we're going to continue 2024 spending through December. End of December comes around, there's a big fight at the end of December, and the Congress decided, okay, we're going to kick this out to March, specifically this Friday. As of this Friday, that continuing resolution ends, and we're now, again, out of budget. And if we don't have a new continuing resolution, because we're not going to have a full budget bill, if we don't have a new continuing resolution by this Friday, the government's going to have to basically do what's called a partial shutdown. And a partial shutdown essentially means that each agency defines their essential services. There are certain things that are essential. Homeland Security says we have to have border security. TSA says we have to have TSA agents. And so they don't pay those things. They basically take an IOU for those things. And then there's a whole bunch of non-essential services like regular people that work for the government, they get furloughed. And other government services kind of just go away. National parks, you can't get into national parks when there's a partial government shutdown because there's nobody working.
Who's going to stop you from going in though, Jay? There's no one working there.
That's a good point. I've never tried. I'm guessing they lock up the gates and the police.
But Jay, why even pass a bill anymore? Like, why pass a budget when we could just live on continuing resolutions? Like, why do we even need a budget?
Here's the crazy thing. So we need a continuing resolution. It has to be signed by this Friday. The House has proposed a continuing resolution. This continuing resolution will go through September, which means literally we're going to have a continuing resolution. The 2024 budget could potentially go all the way through the entire fiscal year 2025. We may never see a 2025 budget bill. And that means by default, the 2025 budget is essentially the same as 2024. Now, there are a few changes that are proposed in this new continuing resolution, a little bit more money to defense, a little less money to non-defense, a little bit more control, some power being given to the president to control how some things are spent. But they need to pass this. And Republicans have basically proposed this continuing resolution. The Democrats have said, we're not going to accept it the way it is. If you want to raise defense spending, you have to raise non-defense spending. If you want to lower non-defense spending, you have to lower defense spending. And that's the only way they're going to vote for it. So basically, we're in this position where, assuming the Dems don't vote for it, the Republicans, they're going to need essentially every vote in the House to pass this. I think they can afford to lose one.
And the Dems have said there's no way they're voting for any of these. They're just sitting it out.
They're not.
Yeah, and that's what they
solution.
said.
You know, Warren Buffett's come up with the best solution of all times, right? Warren Buffett's come up with a solution not only for this, but really also for the balanced budget. It's like, hey, we can get a balanced budget tomorrow. We can get these bills, these government bills done. All you need to do is pass a law that says if they don't do this, every member of Congress is ineligible for re-election. Then it'll just happen.
Yeah, 100%.
How embarrassing is this, though? Let's just, if they pass a continuing resolution to next October, just think about this like bigger scheme. Like the Republicans went out and they worked their asses off, and they got Congress, they got the Senate, they got the White House, and yet they're going to run off a Democrat budget for that 2025 budget. It's basically going to be on a Democrat budget. To me, that's like, come on, man. Like, how pissed are you if you're a Republican who can't affect this and you're just sitting back and watching this?
And that's a best case scenario. A worst case scenario is the Republicans can't among themselves come to unanimous agreement. And trust me, they can only afford to lose one or two votes. And so it's not that easy to get unanimous agreement amongst 216.
I mean, just remember when Congress was Republican last time and they wanted to repeal Obamacare. They couldn't get it done.
They missed it by one. John McCain.
They had a majority. They had the presidency. They had the White House. They had the House. They had everything. They couldn't do it.
Well, the House, apparently it's hard just to get everyone to show up for these votes, eh? Like, it's like, they're like, oh, we have the cushion, with 4 votes, but then like 2 people don't show up. And then all of a sudden they're like, oh, we don't have that anymore.
Somebody gets into a skiing accident, ends up in the hospital. Somebody gets into a car accident. Somebody gets stuck in traffic.
Tell you what, those Democrats always show up for these votes, though. There's every single one of them's accounted for.
Well, they need it because they're in the minority now. And so at this point, this episode comes out on Thursday. I suspect we're not going to have a passed continuing resolution by the time this episode comes out. Maybe we will, but I don't think so, which means after this comes out, it'll basically be 48 hours to pass the bill. And if we don't have it by Friday night, Saturday, we have a partial government shutdown. And we've had 5 of those in the last 20 some years, since the mid 90s. So, well, that's 30 years. Amazing how time flies. We've had 5 of those in the last 30 years. And they can last days, weeks, and it's not pretty.
I don't like to shit on one party or another, but I just want to show how far we are away from the budget here. Like, just something that, like, it's a talking point in that I feel like people are just kind of like not acting like it's a big deal. But if you just look at, I was watching this program the other day, and if you just look at the fact that one of their proposed budget line items, the reason everyone's saying like, oh, Medicare, Medicaid, it's going to get cut, is because when they go do these budgets, they don't actually go line by line item and see what they mean. And so they propose a budget and they say, okay, this office has to cut X amount. This office has to cut this amount. And they put in for this office that it has to cut $880 billion. But if you look at the entire budget for the office, there's only $581 billion available to be cut. So if they cut absolutely everything except for Medicare and Medicaid, that's only $581 billion. Their proposed budget has them cutting $880 billion. So obviously everyone's freaking out. Medicare and Medicaid's getting cut, and then you have to have the president come out and say, "Well, there's no way we're touching that." And then my point is that like we're worrying about whether or not they're thinking of the interest payments going up in their looming budget, and they can't even get to the point where they're looking at like, okay, if we put this much cuts in here, what's going to be the downstream effects that we would have to cut Medicare and Medicaid? They're not even thinking that order of thinking. So they're nowhere close.
And again, it's even worse than that, because what you just showed was what was in that budget resolution. That was basically the guidelines for the 2025 year budget, the 2025 budget. We may never see a 2025 budget. So all that work that went into laying out the guidelines for that budget may never exist. And we may push this and now start working right on a 2026 budget, which, remember, April 15th is when we're supposed to have the budget resolution for the following year. So we're less than or about a month away from starting on the 2026 budget, and we're even close to the 25 budget. So it's gotten ugly. And this keeps getting worse every year.
Government the ability to even run over, like it's just they don't even know which way's up or down. Then they can't agree on the actuality of whatever it is. It's
and
like,
let's be clear. We keep saying government. This isn't government. This is Congress. This is
exactly.
This is one third of government.
Yes.
This is not the president. This is not the judicial branch. This is the House and the Senate, and those 500 people, 550 people there that basically control our lives, that can't get their asses back into their seats and do their jobs. And yeah, they should all be fired.
It's also the reason back when the election happened, all the Democrats were freaking out that, okay, they got all three. And I kind of looked back and said, okay, well, Trump got all three last time, and he wasn't able to push through all of his policy agendas that he said last time, because just for this reason, how inefficient the systems are, and they're not going to be able, like,
it's actually built for that. And a lot of people don't understand. And that was the thing, even, you're right, when Trump got elected, everybody, oh, the world, I'm like, Obama couldn't. Nobody can. And it's built for that president to not be able to do things. And that's what people don't understand. The system's actually made to stop the government from doing a lot. And so when you give them the ability to do way more than they should be doing, it like fundamentally breaks down because they can't do anything. And it's like, that's the problem, especially with debt in the government, is once you get it there, you can't take it away because they can't even organize and get things going. And so and then it creates chaos for all of us.
I'm there's plenty of bad stuff to say about Bill Clinton. There's plenty of evidence he is not a good person. But I will say that he was the last president that did a decent job of corralling Congress, getting everybody on board on the same page, focusing them on a plan and actually getting them to execute. And I'm not going to say that he gets a lot of credit for that or all the credit for that. I think Congress was probably a lot more well-behaved and willing to do their job back then. But
they fired 400,000 government employees. It was 400,000.
And they did it. They did it without a recession, and they did it with everybody had a smile on their face. And I think
it will never happen today.
Absolutely not. Absolutely not.
All right. Well, we probably spent a little bit too long on this, considering the most likely scenario is they're just pushing this off to October. But I feel like it was still
be able to talk about it again.
Yeah, we'll probably talk about it just like tariffs. We're probably going to talk about it again. So I got a fun one here, and Jay, while I'm doing this, you could queue up your hypothetical situations, because I already see you getting your little smirk on your face when I say it. But I got a fun one where it popped up in one of my Instagram feeds, and I thought it was pretty funny.
You have an Instagram account? What's your handle?
Stop it, Mauricio. Mauricio does this thing every once in a while. I try to lurk on Instagram. I don't want anyone knowing who I am. And Mauricio constantly just tags me and stuff just because he knows I don't want anyone following me. So that's where this joke is. Mauricio's chuckling over there with a big grin on his face. In my Instagram feed, I thought this was a funny thing because Elon Musk has been in the news, and my two daughters have unique names. And they were talking about the names of his kids, and the only person who kind of holds a candle to Elon Musk and his kids and his name is Nick Cannon. And so they played this game where they said, okay, I'm going to put up a kid's name. And is this kid Nick Cannon's kid, or is this Elon Musk's kid? And so I'm gonna put up names for you guys, and I want you to guess: is this Elon Musk's kid or is this Nick Cannon's kid? Okay.
You could hit any name available, and it would have to be one of their kids because they have so many.
Yeah, they have so many kids. Like you could just come up with a name. All right, here's the first one. So, oh, this is actually working. I wasn't sure if I'd be able to share this little thing. So this is Zion Mixolydian. Zion Mixolydian. What's your guess? Is this Nick Cannon or Elon Musk?
I think that's Musk.
I think isn't Mixolydian like a musical term? So I was going to say Musk, but I'm going to go with Cannon because I think it's a musical term.
2 out of 3. That is Nick Cannon. I agree. That was one that I kind of wasn't sure about in the beginning, and then I got it wrong. So next is Exa Dark Sidereal.
These are not real names, right? You're making this up?
No, this is a real name. Exa Dark Sidereal.
It has X in it, so it's Musk.
Yeah, that's what I was thinking. I'm like, X, got to be Musk.
I'm going with Musk too.
You are correct. This is Elon Musk's kid. All right, next one coming up is Zillion Hair.
Is it spelled with an X?
Nope, there's no X in it.
I'm going with Cannon.
Cannon.
Musk.
You guys are right. This is
Cannon.
Cannon.
So, yeah, Cannon.
It's like, so if you want to talk about if you say it fast, it sounds like zillionaire. So that's kind of that would be kind of a shoe in. I tried to break it down here. Next one, Onyx Ice Coal.
It has an X in it. I'm going Musk.
No, yeah, I think Musk. Onyx. But
I think Nick Cannon was doing an homage to Vanilla Ice. So I'm going to go with Nick Cannon.
Nick Cannon. This is a Nick Cannon kid. I'm glad it worked out that there was an X one. Next one's an easy one. Everyone's going to get this. The name is, if I think I could pronounce this, X Ash A12.
I think that's an easy one.
So I think everyone knows that's Elon Musk. And then we actually have twins here. The twins are Strider and Azure. Do we think that's Musk or Cannon?
Cannon, for sure.
Yeah, I'm going to go Cannon.
I don't think Musk has twins, does he?
Who knows? He might not.
AJ?
I'm going to go with Elon.
That is Elon. That's the most normal of the names. So you had to throw it. I feel like if you throw in a couple normal ones, that's where you're going to get tripped up as much. And then finally, the last one is Techno Mechanicus.
No, that is Musk.
There's no X in it though, Jay.
No,
actually, no. This is the last one. I got one more after this.
Cannon. Mechanicus. Techno is techno music. I'm going to go with Cannon.
So this is Elon Musk. Elon Musk is Techno Mechanicus. Yeah, all right, last one is Ultra Rosa. What do we think? Ultra Rosa.
Is that like Michelob Ultra?
What's your guesses?
Cannon.
Yep. Wrong. That's actually the flavor of Monster Energy that I have right now. That is not it's not a kid's name, but it kind of just points out what we
touche.
How we think about these names. That it could be basically anything, and we would believe that was their name. All right, Jay, you got a hypothetical situation for us to finish off?
I don't have any really. I'll go with this one. You can Groundhog Day yourself. And for those who haven't seen the movie Groundhog Day, basically you wake up every day and it's the exact same day. When you fall asleep at night, you wake up the next morning and it's the exact same day over and over and over for you, not for everybody else, but for you, it's the exact same day over and over. But so you can Groundhog Day yourself. You don't know what day it's going to be, but you need to decide, or what's going to happen that day. You need to decide the night before how long you're going to choose to stay in Groundhog Day.
1 month.
Okay.
I feel like 1 month I could go and figure out like almost every way to make money over the course of that day and every bet I could make. And that's all I would need.
I
1
agree.
month.
30 days and I'm good. I 30 days and I wouldn't walk away from a computer. All I'd be looking at is option spreads and like I'd just be like, and I'd figure out like
there's got to be a major lottery every day.
I'm not following. I'm not following. So you figure it all out. You make a bunch of money, but then the next day you're back down to zero.
No.
No, you get out of it.
The last day goes into the regular.
Last day you make all your bets.
Yeah.
Okay.
That's all I would care about. I know some people would say like, oh, I could learn how to speak French or play the guitar. Or
you can do that,
like
after you've made, $1 billion
Billions of dollars.
in a day.
Yeah.
Exactly. Yeah, I think we all agree. A month is about the right number.
Yeah, I mean, I might do 2 months just to play it safe because I feel like 2 months is long enough. Like you might be a little rushed, but yeah, I'll get a change. 2 months. 2 months. I think that's because some of these things I got to figure out how to do it right. Like
plus, you're going to get sidetracked for at least a couple days. Like just do
like
other stuff.
Some of these things, like I can't load. Like I got to figure out how to create high margin accounts and stuff like that. I've never done any of that stuff, so you got to spend some time researching. So maybe 2 months. Wow. I guess that shows how all of us are. We're all just completely money driven. We have no other motives at all. We could probably solve some world issues. We could probably do all that. Like,
there's one other thing.
How much money can we make?
I would tease my daughter every single day, and I would figure out what gets her goat the most, and then I would have that in my back pocket. So then I could use it to tease her. So. Do that too.
I mean, you could visit a lot of places too, right? Like if there was, because money's basically no object, right? Like if I want to just go to the Maldives for the day and like you just spend all the money it takes,
blow all your money every day.
Yeah. Or you could pull the actual Groundhog Day like movie where you just like, okay, what's a cool way to die today? Like
I would definitely do that.
Yeah, you got to at least kill yourself.
Got to try to rob a bank. I mean, can I get away with it?
Yeah, for sure. Yeah.
Here's an interesting thought experiment. Everybody in the world has to choose one person to die. Do you live?
Everyone in the world no, I don't.
So basically, you're saying, is there someone out there who you are their worst enemy?
Yeah.
Not even worst enemy. Like it could be like, I think that guy's a jerk, but I don't want to pick somebody else, so I'll just pick him. Like, because think about it. You're trying if everybody has to pick, you're trying to get the worst. Like it doesn't have to be the worst person in the world necessarily. It's the one that affects you the least.
Yeah. I mean, I guess is it publicized who you picked?
Nope.
Or who picked who?
Nope.
Oh, then AJ, I think it's just like hate.
I think
every politician I like this idea. Every politician in the world would be gone, like immediately, like clean.
I think you're AJ. I think you're overestimating the pettiness of people. Like someone, like, do you think someone who, like, even someone who's important, like, they all have some enemy, some person.
Yeah,
that they hate.
There's nobody that's like, I'm going to use mine on AJ when they could use it on like that kid that bullied them in.
But that's what you never know. Like it could be someone like AJ, like who was your wife's ex-boyfriend who like he just like absolutely hates you and like
so
you're done.
It's kind of crazy, but
or it could be your wife's current boyfriend.
That's more likely because I was her.
That's the one you really have to worry about. That's the one you really have to. That's the one I'm worried about.
That's an easy one.
That's the one I'm worried about.
For sure. I think I'm good though. I don't think I have anyone who hates me that much. Jay, I think you might be in trouble. I think you're honestly,
Jay, you can come hide in a bunker with me. Okay, we'll hide and lock the door and like guard ourselves.
I like to think whoever hates me that much, there's somebody else they hate more.
Yeah, I'd hope so.
I'm just a symptom of their hate.
I don't know. I've heard a few of your stories about like lawsuits and your pettiness and like your like stuff like that. Like I think there's got to be someone out there who's writing your name on the wall in lipstick. Like it's like there's got to be someone. All right, let's wrap this up. That was a good one, Jay. So I'll let you go first for the plug. What do you got for a plug?
Let's see. AJ's deal's already funded. Mauricio, did you launch your coaching program?
I did. I had a great launch last week, and we're still going.
Where can people sign up for that?
Coachingwithmauricio.com.
Okay, that's my plug. Coaching with Mauricio.
Plug VC investors for Conference Connect.
Oh yeah, and so Conference Connect, we're raising capital. We've got a bunch of angel investors and raised a bunch of angel capital. So if you want to get in, and
only if you're cool, though. We're only letting cool people in.
Are you allowed to say that? Are we allowed to say that you have to be cool? Yeah,
Mauricio. Is that? I mean, it's not technically.
What if it's not true? Like, what if we let you
in,
Mauricio? Is that considered a material lie?
No assholes policy. We invested. Actually, that you know where that came from? That came from Clear Rum. Clear Rum We invested in Clear Rum, and at their investor meeting, they had a thing where they were like, "We have a no assholes policy," and we just thought that was awesome. So so that's kind of what we were adapting. So if you're not you want to jump on the train, come check us out. Contact Jay. Jay's the one who's most available.
There you go.
That's Jay's plug, not mine. AJ, what do you got for us?
Mauricio's coaching program.
Ooh,
just
let's
rank it up. How he has it set up, like his group thing. The value, it's kind of crazy. He hasn't been doing it for very long, so he's not charging enough. But like you get access to his knowledge, everything, what attorneys cost. It's
there's definitely a gap in the knowledge, right? Where you have like the free shit that's all available, and then you have signing with a lawyer, right? Like it's kind of there's nothing in between where you can kind of
nothing in between. Something was like, I want to meet with you for 15 minutes. I'm like, it's cheaper just to go in the freaking for a month of the program.
Right. You might exactly. So
I've already talked to him about this. He has to charge more because it's not in line. It's so dang. So I just think it's cool.
And the prices will be going up. And she's like, I wanted to get a community in there. So I wanted the people get in there. I want to be doing the calls, a bunch of, so we was good. It's all good. But I appreciate the plugs. I'm going to plug DRE Daily. I still think that is an outstanding newsletter that goes out. Is it dredaily.com for them to sign up, Jay?
It is.
Man, if you want a week, just a daily snapshot of what's going on in the economy and the headlines, it's kind of it's awesome. You can spend as much time or as little time as you want. If nothing else, you'll know what the rates are, what the stock market's doing, what the gold price is doing, and all the headlines of the day. It's awesome. dredaily.com.
Check it out. And as always, I'm going to go plug my wife. Badass Investor at Badass Investor, much better looking than Jay and smarter too. That's all I got, guys. We're gonna miss you, AJ. Next week, I don't know. We're gonna drop a tease for who we got because we already decided, or are we gonna just let it be a surprise?
He's got a bigger show than we do.
Much bigger show. It's been around a lot longer too.
Yeah.
Well, I will tease a hint. His show was on actual radio before podcasts were a thing.
Yeah.
So it was good enough that it got a radio show, not just anyone could have a podcast, right? So,
another hint: he is a guy in real estate.
All right, fair enough. But it's been fun when we had it. AJ, we'll see you in 2 weeks.
By the way, fun fact: Australia is wider than the moon. There you go.
Is it really?
I'm ending with value on this episode.
Hold on, is that true? Is it?
Yeah.
It's wider than the moon?
Yep.
But not quite as wide as Jay's ass. I will see everybody. See you next Thursday.